more and more demand amongst the clients at all levels, at the retail level, but also at the institutional level, the hedge fund clients as well. They are good at technical analysis, and they demand it from the sell side, from the prime brokers that are offering them services. They want technical analysis research. But when you're in a market where actually you have some knowledge that other people don't have, and they really don't have it, then you've got an inefficiency which you can exploit. And that will decline over time as the market itself gets more sophisticated, more liquid, but actually I wouldn't be pessimistic about that at all. I would suggest that certain technical analysis, certainly particular technical analysis, will work very well here. Certain will not work here, but the reason it doesn't work is it's to do with the liquidity question. Some technical analysis requires high liquidity to work. What are the limitations of technical analysis generally? So not just the Nigerian market, but when does technical analysis not work? Well, the first thing is liquidity. Technical analysis is studying the behavior of a crowd. Okay? We get the value that the crowd puts on something, which is the price. The price is the balance point of where all the buyers and the sellers are currently met, and if the buying is more intensive, then the price will go up. So when you know the price, you know actually all the fundamentals already. And more importantly, in terms of technical analysis, what people think they're worth, plus their hopes, plus their expectations for that security. So if you take say something like Lafarge cement, it's not trading now because it's Saturday, but if it was trading this second at a certain price, that price is not what people think that Lafarge is worth. It's not a price discovery mechanism, it's not a value discovery mechanism at all. It's not what it is worth, and if it ceased trading today and it dissolved the whole company and liquidated the company, how many naira would you get back per share? That's not what that price is. It's that plus our hopes and expectations for it. And so the market is a forward discounting mechanism. It's got expectation in it. We don't buy, we already know what it's worth. But what we do is we add to that our hopes and our expectations, and sometimes our fear as well. So the price can be below fair value for the security, the actual correct value, if you like, from a fundamental point of view, because people expect it to get worse, and that's built into it. So the market is built up of not only the hard facts, the fundamentals, but other things which are actually psychological things, aren't they? Fear, greed, expectations, hope, those sort of things. They're human things that are part of the price. So the sort of formula for the price is W plus X plus Y plus Z equals P, P being the price. The W being the fundamentals, plus X, the hopes, fears, expectations of the investors equals the price. So you've got all those parts equal the price. They have different values sometimes. We revalue the security, the price goes down, let's say, very quickly as a result because it isn't worth as much as we thought it was previously. At that point, the market is efficient. It's obeying the efficient market hypothesis at that point. But mostly when the market is calmer and the share is perhaps delivering its dividends on time, exactly in line with expectations, it doesn't feel threatening to us, then we think further ahead. We don't have to worry about what's going to happen shortly, we think further ahead. So the price is actually pricing further ahead and how the security will do in the next interest rate cycle or something like that. And so the price moves forward. But then if there's a shock, the price moves back to reflect only the fundamentals. What do I mean exactly by liquidity? As I sort of began to say, it's not quite simple. What would be a really simple answer would to say technical analysis doesn't work in any share which doesn't have an average turnover, average volume per day of so many shares. It would be really good if you could actually put a number and say if the share doesn't have a turnover of more than that, then don't use technical analysis. But actually that will mislead you, because some things which have high turnover don't have, many of the trades are large blocks of trades, and actually we're only a few trades making a large turnover. So that's sort of not really liquid, you can't really participate in that. But if you went from that low to the high that I've marked there in September, then pull back to the November low. So if you think of that as A at the low, B at the September high, C at the November low, then
December.
November low, yeah, November low. Well, let me go point to it. Yeah. A, B, C. If you take the length of AB and add it to C, that's what it came up with. So as soon as you were convinced that that was a low and we were starting to go up, actually, where are we going to go? It's here. We've actually got to it now. That's 100% of that move there. It's amazing, actually, that should be so, but it is so. It's not magic, by the way. It's logical. You know, the longer the move up, so that's a very strong market, isn't it? A long move up. The smaller the move down, the BC part of it, in relation to the move up, when it starts to go up again, the bigger the move you're likely to go next. So if you've got the length of the move up and the size of the reaction, then you've got a lot of information about what's going to happen next.